Welcome to today's market report. European Stoxx 600 index ended lower on Monday as declines in tech stocks offset gains in banks and energy, while German shares hit 10-day highs as the federal election outcome reduced the chances of a left-wing coalition forming a government. German's blue chip DAX rose 0.3%, leading gains among regional indices, while the pan-European Stoxx 600 index fell 0.2%. Germany's centre-left Social Democrats were set to start trying to form a government after they narrowly won their first national election since 2005, saying they would seek to form a coalition with the Greens and the Liberal Free Democrats by Christmas to take over from Angela Merkel's Conservatives. Investors were relieved that hard left Link Party fell below the 5% threshold needed to enter parliament. The left-wing Die Link party's poor election showing appears to have ruled out a left-wing alliance and its likely negative impact on German stocks, according to BlackRock. We see the election outcome eventually resulting in a moderate left or right-leaning government. German real estate company Vonovia, aircraft engine maker MTU Aero Engines, and the renewables company Siemens Energy were the top gainers on the DAX. The oil and gas index climbed 2.8% to hit a 3-month high, while banks added 2.8%. Oil majors Total Energies, Royal Dutch Shell and BP rose between 3.4% and 4.8%, providing the biggest boost to the Stoxx 600. Concerns over the possibility that tech stocks have been pumped up by ease money brings a potential shift towards pro-cyclical laggard, which often rise as yields improve, according to IG. While worries about hawkish central bank policies fell out from China Evergrande's financial troubles and inflation have weighed on sentiment, investors are hoping that vaccination will drive a steady global recovery. The Stoxx 600 index has climbed 15.9% so far this year, falling slightly short of 18.3% rise in Wall Street's S&P 500. Crude oil WTI was up 2% to $75.47 per barrel. Brent was up 1.8% to $78.64 per barrel. Gold futures was down 0.07% at $1,750.45 per ounce. On the FX front, after closing in the back foot on the last week, the cable is recovering, trading at 137.04, up 0.12%. Market mood is upbeat as European indices are trading higher, while it is a mixed bag in the US. The Dow Jones Industrial Average is up to 35,000, gaining 0.7%, whereas the S&P 500 and the Nasdaq are down 0.09% and 0.95% respectively. The dollar index was steady, gaining 0.14% at 93.40, underpinned by rising yields with the 10-year yield Treasury recording gains of 0.20% at 1.478%. In the UK, the economic docket is empty. However, Wires reported that 50 to 90% of natural gas stations are running dry in some areas, and this shortage could derail the recovery. The Bank of England held interest rates on Thursday, and its bond purchasing plans unchanged, nonetheless hinted that a hike might be on the cards even before the central bank tapers its bond buying program. The decision is influenced by rising prices as the BOE expects inflation to rise to 4%. Meanwhile, the US Census Bureau released durable good orders data for August. Figures rose by 1.8% more than the 0.7% foreseen by analysts, smashing the previous month reading of 0.5%. Excluding defense, new orders increased 2.4% against the minus 0.5% expected. Demand for durable goods has expanded 15 of its last 16 months. Early during New York session, Chicago's Fed President Charles Evans crossed the wires, commented that the US economy is close to meet the Fed's bar for beginning to reduce the bond purchase program. Further, an improvement in the labor market will likely meet the bar soon set by the central bank, and bond tapering can begin. Eurodollar retakes the 117 area after challenging monthly lows near 116.80 during early trade. Eurodollar adds to Friday's downtick and keeps the door open to a potential move to the year-to-date lows in the vicinity of 116.60. The leg lower in the pair comes in response to the strong improvement in the dollar. This is today's market news. Thanks for listening. We'll see you next time.